Hi, you guys. This is Phil Town for Rule 1 Investing. We're going to talk about the balance sheet right now. Balance sheets are incredibly important. They're one of the three financial statements, which are the income statement, the cash flow statement, and the all-important balance sheet. This is what you take into the bank and you go, hey, we're a good company. Look at this. We have a balance on our balance sheet. Now, the reason it's called a balance sheet is because what it does is it says, give me the value of all of the assets you've got in the company, okay? Add all those up. And then give me the total balance of what the total amount that you've got for liabilities, what you owe, and then put in the difference as what's called equity. So let's say you've got $100 on your balance sheet in assets and you owe $50 on your liabilities. You owe that to the bank someplace. And what you have left, of course, when you subtract the $50 from the $100 is you have $50 of equity. Now, the balance sheet is called a balance sheet because the assets have to balance the liabilities and the equity. Those two things balance out. So let's take a look at these major three pieces of the balance sheet and how we use them to research for a really healthy, good company. Now, the first piece of the balance sheet is called the assets of the company. Now, you know about assets of the company. If you did a personal balance sheet, it would be the value of your house, assume you own it, the value of your car, the value of your snowboard, the value of your furniture. All that stuff gets thrown into the assets. It doesn't matter if you owe money on them. You just put in what they're worth under the assets of the company. Now, included in those assets are things like the balance of your banking account, the balance of your brokerage account, the balance of your 401k. All of those things are in the balance sheet as an asset. The second piece of the balance sheet is called liabilities, and those are the things you owe. So now, if you own a house and you have the value of the house in the assets, you now have to put in the loan value into the liabilities. So you put in what you owe on the car, what you owe on the house, any loans you've taken out, credit card loans, all of that stuff goes in as liabilities. Now, to get to the equity, it's real simple. You just take the total value of all of your assets, you subtract the total cost of all of these liabilities, and you get what's left, which is the equity or what you're worth, right? So those are the ways we structure the balance sheet. Now, what's a red flag to look for and what makes a balance sheet look really healthy? Well, obviously, if you've got more assets than you got liabilities, right? If you own more stuff, the value of the stuff is worth more than what you owe on it, that's a positive thing. And what we look for on the balance sheet is that equity, the difference between what you own and what you owe, is growing all the time. It's just getting bigger and bigger and bigger. Now, that's really super important because what it means is that you are actually in a business that has money going down into the equity of the business. A lot of businesses make money, they have good sales, they've got good profits, but the profits never make it into the actual equity on the balance sheet because they turn right around and reinvest that into stuff to just be able to keep going as a business. Where we want a business where the balance sheet is growing. That's one of the most wonderful things we look at. We also look at what's called working capital on the balance sheet. Working capital is really simple. You take the current assets, the ones that can be turned into cash in a year. That's things like cash in the bank, right? Accounts receivable you're going to collect this year. And you subtract out the things that you're going to pay out this year. So the stuff you got to pay for, like accounts payable, you're going to get rid of, and that part of the loan you're going to pay off this year. And what you want to see is that the current assets minus the current liabilities are a positive number. That means you have positive working capital, okay? And what we'd really like to see is that it's about 2 to 1. Now, good companies have 1 to 1. That's fine if they obviously know what they're doing. But in a company we're just looking at, really looks nice if they've got at least a 2 to 1 ratio between current assets and current liabilities. So those are the critical things we're looking at on a balance sheet: the growth of equity, good current ratio, and what we want to look at, if a real bad balance sheet, look at GM back before it went bankrupt. That was an ugly looking balance sheet right there. And a really good one, again, Apple Computer, fantastic balance sheet. And of course, we always use this balance sheet equity growth as the number one growth rate to figure out the future value of all the cash in this business. The equity growth rate, according to Warren Buffett, is much more likely to be the true growth rate of the company in the long run, the true growth rate of its intrinsic value. And in fact, he uses the equity or book value growth rate of Berkshire Hathaway to go out to his investors and say, here's how we're doing. So if you like what you've seen out here, you guys, subscribe to my channel for more of this. great Rule 1 content where we're teaching you how to invest like guys like Warren Buffett. Until then, I'm Phil Town for Rule 1 Investing. Time to go play. See ya.